partnerships, part 2, what if there is a termination and it ends up that some of the partners have negative balances? Well, then usually what you want to do is what's called a pre-distribution plan. Deficit balances can be resolved 2 ways. Either the deficit partner can make a contribution to make up the deficit, or the remaining partners can absorb the deficit. The deficit partner may pay later or can be sued by the deficit amount. Let's take a look at an example. Here we have a partnership. We have loans between the partnership and some of the partners going both ways, and the partnership decides to liquidate and sell the non-cash assets for $80,000. The liquidation expenses are $21,000. So let's prepare a pre-distribution plan or schedule of liquidation. What amount of safe cash can be paid out after the sale of the assets, assuming that any deficit balances will not be paid? So here's the thing, remember, is when you're going through this, in order for you to pay out safe cash, you have to assume that even though you may still have more assets, there's the assumption you'll get nothing from them. So the first thing you always have to do is get rid of any loans between the parent and the partners. So we start with their beginning balances. We transfer the loans. And now we have a new adjusted balance, which is what we're going to start with. And again, accounts receivable is converted to a draw. And a partner loans payable is converted to a capital contribution. These are going to be the balances. We're going to start with the liquidation schedule. So first, what we're going to do is we're going to record the sale of the assets, which is we got $80,000, but we're going to assume that the other $82,000 was written off. This is so we can come up with safe cash. Then we're going to pay off our liabilities, and we're going to allocate based on profit sharing the liquidation expenses. And now we end up with our balances. And in this example, Bill now has a negative balance in terms of that needs to be removed, or he needs to give the business $1,200. Well, in this example, we're going to assume he doesn't. So what we need to do is allocate it based on the remaining percentages. So that means Pam would get 50/60 and Myra would get 10/6. Now we know that we can safely pay out at this time. We would have safe cash of $39,000, and we could give a check of $29,500 to Pam and a check to Myra for $9,500. So again, this is amount that we can give, and any negative amounts has to be allocated to the remaining partners before we can pay any money out. Now let's take a look at one more example. In this case, the profit is 20/40/40. We have, again, they're going to sell off their assets. We have loans between the partners and the partnerships, and we have liquidation expenses of $6,000. So again, first, we have to eliminate the loans. It's very important that we do that. And again, an accounts receivable where the partner owes the business money, that's treated as a draw and a reduction in their capital account. And if the partner loans the company money, that's treated as a capital contribution, which increases the capital account. Now we're going to use these balances to figure out what safe cash can be contributed. Now again, I always put the percentages across the top and then the balances. Then I record the asset sale and I distribute the difference of $82,000 to the partners based on their profit sharing of 20/40/40. I then pay off the liabilities. I allocate the liquidation expenses based on profit sharing. And now we end up with a $15,000, $200 deficit balance for Myra, which we have to get rid of by giving 20/60s to Pam and 40/60 to Bill. So we're going to allocate the negative amount. And now what's going to happen is Bill has a deficit balance. We're going to take this against Pam, which means that we can safely, at this point, once we've sold some of the assets for $80,000, we can give her a check for $54,000. That ends this presentation on liquidating partners.